Well, my name is Judy Lloyd. I am an accountant, a CPA, which stands for Chartered Professional Accountant, and have been for many, many years. I retired from accounting in 2011, and I'm now just doing a lot of teaching and talking about money rather than actually making money, which most of you can probably identify with. The F in the letters that follow my name stands for fellow, which means that somebody thought that I'd done enough hard work in my life to deserve to be a fellow in the society, which I guess means I'm old more than anything else. But it's kind of nice when other people recognize that you've done something. Okay, so today's session is managing your finances in retirement, and something that's a timely topic because right now we're facing a lot of challenges in inflation and in rising costs and not rising incomes necessarily. So it's going to be an interesting time for all of us in the next little while, and this topic is right on right now. Reality has a bit of a surprise for us very often in the form of either money or health or lack thereof, because we have really good plans and all of a sudden reality has a way of shoving those aside and saying, okay, this is what I want you to look like right now. And so today I'm going to try and share with you some ideas and some tools to help work around the realities that might make things tougher, and to give you some ideas on how to manage rather than just accept what's going on around you. So our agenda for today, we're going to talk about the importance of managing your retirement, managing the money, managing your time, and making everything work. So we'll talk a little bit about that. I'm going to talk a little bit about budgeting and bringing that into your lifestyle. Some of you probably already do that, but the art of budgeting is a very useful tool for helping you to visualize what your time and money will look like and what you can actually do without stressing yourself in future years. The next thing we're going to talk about is some common strategies in retirement so that we can maximize our income at the right times and make the best use of our money. And so we'll talk about some of those common strategies. I'll leave you with some tools and some other resources that you can look at so that you have other places to go. There's a lot of information out there, but some of it is better than others. And so I'll give you some resources to take a look at, and then hopefully we'll have some time to answer your questions if you have any. I may be so wonderful that you've all fallen asleep by the end and then there will be no questions. Who knows? Anyway, I'm going to share my screen with you because I have some really good slides. This program is put together by the Chartered Professional Accountants Association as requested by the Government of Canada to help people learn more about money. And so we have a number of programs, including a number that are targeted at seniors. And so the impetus was to create a financially literate population. And I think that at the senior end of the scale, we're much more financially literate than at the junior end of the scale, but there are programs across the board for across the age board and across the diversity board for people to learn a little bit more about managing their money, courtesy of the Chartered Professional Accountants. So that's what we're working on today. I'll be with you for about an hour with questions. Maybe we'll run a little bit over time. We'll see how that goes, but I'll do the best to stick within the hour. Okay, I'm going to share my screen with you and we'll be looking at slides. You will get a copy of these slides after the program so that you'll be able to use them to remember what I said and to be able to review some of the information. Okay, so we're going to start with why do you need to manage your retirement finances? And the first and most important factor is that we are the healthiest, longest living population in history. We've lived a long time, got to retirement age at 65 or wherever you've chosen to retire, and we have a lot of years ahead of us. If we do get sick, we have very good health care that tends to bring us along back into the a healthy lifestyle so that it prolongs our life and prolongs the healthy part of our life, the enjoyable part of our life by giving us good health. So having said that, obviously our money has to stretch over that longer period of time. When we were younger, I'm 75, so I'm in that seniors age group. But when we were younger, when I was looking at people retiring and thinking, oh God, they're old, you know, those people were retiring at 65. They had saved their money, they had their pensions, they expected to live about 8 years. Now we look at 65 and we expect to live at least 20 more years. So enhances the need for money. We're going to need more money in retirement savings. In any sort of lifestyle. Some of us are lucky enough, not me, but some of us, to have employer and government benefit plans, but those too are changing and are not as lucrative and beneficial as they used to be. As people are living longer, they have to be spread out over a longer period of time. So all of these factors make it much more important to manage our money, to understand how much we have, and to plan a little bit better. Studies have shown that people who do understand their finances, who do have long-term financial plans for retirement, are far less stressed than people who don't. So we always want to keep that in mind. Okay, so what's this all about? We're going to first of all take a look at this whole idea of money flowing through our life. So we have money coming in, and we want to look at that. We want to make sure that we understand where our money is and where it's coming from. We use that money to pay for our lifestyle. So we need to take a look at those uses and how we're spending our money. And that's where that whole art of budgeting comes in. It's making sure that the money coming in and the money going out work together. And then, of course, at the end of the day or the end of the year, do we have any left over that we can save for next year or put into some other endeavor? Or are we running short and therefore have to rethink coming years? So understanding that becomes a huge part of this discussion. Okay, we're going to look at each individual item. So first we're going to look at sources of retirement income, and then we're going to look at the uses of retirement income, and then we're going to look at some strategies that will enable us to look after what's left over. Okay, so where do we get our money from? Generally, as retired individuals, we get our government pension plans. And these come into play when we apply for them. And so you can apply for your Canada pension plan when you're ready to apply for it at any age up to 70, 71, I believe it is. And but you do have to apply for it. And you can apply as early as 60 still. The Canada pension plan, of course, is what you paid into, and the amount you get is dependent on how much you paid in and when you take it out. So it increases if you wait longer. It increases as you put more money in. So even if you put money in after you took your CPP out, it continues to increase a little bit. Old age security, again, an application, and that application to CRA starts the old age security coming at age 65, unless, of course, you have other extenuating factors like disabilities or death of a spouse. And then the guaranteed income supplement is, again, it's something that you get once you file your income tax returns. If your income is low enough, then that guaranteed income supplement will kick in. But it only kicks in if by filing your tax returns, you can demonstrate that you are eligible for it. And it's reevaluated every year. So you do have to make sure that you do the proper paperwork to apply for all of those government benefits. And Anna was mentioning that her mother had some language difficulties. We have a lot of people in this country who are seniors who don't understand the systems, and unless they get some help, do not know enough to apply for some of these things. So it's up to you to make sure that you do apply, and if you know other people who need that information, to pass it on to them. Unfortunately, we don't have a good system for making sure people do get the benefits that they need. Employer pension plans, again, there's often an application system, and with a lot of us, we worked in a number of jobs over our lifespan, unlike our forebears who probably only worked in one place. And so some of you may have more than one benefit plan that you'll have to apply for. And very often, if we don't remember some little bit, we're losing a bit of money. An example, my husband worked for a few years for Perolator, and so he gets a little pension from them, but he had to apply for it separately from everything else. Okay, so those plans, really the only control we have is to make sure that we fill in the proper application for them and to continue to receive them. The ones that we have some control over are our personal savings and investments. So we're going to spend more time looking at those things that are listed at the bottom: the investment portfolio, real estate, side businesses, personal assets. So things that we have control over, and we can turn them into money or use them as we see fit. We have that control. Forcefully by the government and by employers and by my parents to put away money for retirement. And when the RRSP came out, to put money into RRSPs, because I could put that money away, didn't have to pay tax at the time, and then it just continued to build. So many of us do have RRSPs, and we have them sitting there. You can continue to contribute to your RRSP until you're 71. Okay, the year that you turn 71 is the last year you can contribute, and in that year, by December 31st, you have to actually convert your RRSP to a payout system. Usually we go to a RRIF, which is a Registered Retirement Income Fund, and that starts to give us a payout. That we have to take a minimum pay, at least a minimum payout every year after we're 71. We can also convert it to an annuity, which is a standard flat rate payout after the age of 71. Now, there is some tax planning involved in these RSPs and RRIFs that enable us to take that money out. We have to pay tax on it when we take it out. And so we have to look at our other income and decide how we want to do the take out the money to make sure that we don't pay excess taxes on it. And I have had people who have done very silly things, like take out the whole RRSP and pay tax on it, because they say, well, I might as well get that over with and then I don't have to worry about it. But you're paying at a much, much higher tax rate than if you took that money out over a period of time. So the tax planning, sitting down with your tax advisor or with someone who understands what's going on with tax, and figuring out what is the best way to take that money out. You had all these savings over the years, you worked hard for them. Now don't give them all to the government if you don't have to. Okay, we have some other options for our investments, and these are different than the registered or the RRSP and RRIF in that they are taxed in a different way, and we have more control, more flexibility in how we use these things. So the government has put in one tool for us called the TFSA, which is a savings account, a tax-free savings account. So we put money into it, we can take that money back out. Any earnings within the TFSA account are tax-free. So this is a tool that we can use when we don't want to take money out of our registered account and pay tax on it, if we have that flexibility to make it work for us so that our tax picture is better. And so if we want to take some extra out this year because we don't have a lot of income, we can put it into the TFSA from our retirement plan and pay the tax on it this year, which might be at a lower rate, and then take it out next year when we have a higher rate from the TFSA. So we've got some flexibility in working with our retirement plans. And those of you who are in that 60 to 65 or 60 to 70 age range, and you are maybe not working anymore, this tax planning, moving money from your registered plan to your unregistered plan is often a really good thing to be thinking about doing. Okay, so use these tools to increase your flexibility into the future. And with the plans like the TFSA, you can put it into an interest-bearing savings account, but you can also put it into any type of investment account that works for you. And so you can earn dividends or capital gains, and they're all tax-free within this TFSA system. There are limits on it, of course, but a good tax planning tool. Okay, we also have totally non-registered, non-government instruments that we can use: personal savings accounts, real estate, investing in houses, little bits of side business. If we have expertise that people are willing to pay for, why not get that money? People value what they pay for, right? And then, of course, many of us have collections of things that are worth a lot, and we can start to sell some of those things off. So our savings, wherever we have them stashed and in whatever vehicle, we can start to use those, tap into those as part of our retirement planning. Non-registered investments, we have things like investment portfolios, segregated funds, insurance investments, annuities. These are things that we also use as tools for funding our retirement. So probably the very first thing that you want to do before any other step is to take a look at what you do have. Make an inventory of everything that you have, and then you've got that over the years of being an accountant, a public accountant, is how many people lose money. They have an account, forget about it, it goes dormant, and pretty soon that money is basically lost to you. It no longer, it's still available, but the hoops that you have to go through to get it are incredible. So if you have a dormant account in the bank, that money after 10 years is forwarded to the Bank of Canada. The Bank of Canada is currently holding over $1 billion of other people's money that has been left in dormant accounts. $1 billion. That's maybe some of it's yours. And much of it is in small amounts, you know, under $1,000. 90% of it is under $1,000 each account, but some of it fairly substantial. But, you know, why is that lost? Well, because we forget that we've got that money. Likewise, we have shares. I had a client who died, and as I was doing his estate work, I saw that he had not received his dividends from BC Hydro. I said, oh, that's strange, 2 years of no dividends. 3 years prior, the shares had been sold. And BC Hydro had notified him at the last address they had, which was many addresses ago. And so he didn't know that they were sold, and he didn't realize that he wasn't getting that dividend. It just didn't register. And so he was missing 2 years of dividends, but he was also missing the value of the shares, which had been bought out by someone else. And, you know, so there was $30,000 of his money sitting there in BC Hydro, not claimed, and therefore would eventually revert to BC Hydro. Gee, thanks, right? And so then I went after the money and finally got it for him, for his estate. But, you know, that type of thing happens all too often. The way to prevent it, make an inventory of all the things you have while you have the mindset to be able to do that, and then it won't get lost. If you forget it, someone else will be able to remember it because it's on the inventory. Okay, so just one caution from the many stories I've seen from my past. Okay, so that's looking at the sources of our money and making sure that we get our money that we are entitled to, we've worked hard for, and looking at so that we know exactly what we've got coming in, looking at that money and looking at those assets and looking at what we can sell to make that happen. I'm going to move on to the uses of that money. So we obviously have to spend money because we're going to have to eat, we're going to have to live somewhere, we need transportation, we need healthcare. So we need to spend money. Understanding how we spend our money and reviewing how we spend our money and whether or not the commitments that we've already made have to stand the way they do are really good things to do right now and good habits to get into so that we're constantly on top of that. And I don't mean that we have to spend every waking moment worrying about where we spend our money, but once a year, we probably should sit down and think about this. And there are various forms of technology that can help us. There are programs, there are spreadsheets, there are apps that can help us to manage our money. But a good old paper and pencil also works very well. So it's just a matter of sitting down and thinking about where our money's being spent. And I noticed that CPA on this list of where your money is going list the important things like food, housing, transportation, and healthcare. I don't see where they put your bucket list, but that's certainly something else that we want to make sure that we have money for, is to do the things that are fun. Okay, a little bit about budgeting then. So we know that we have expenses, and it's easier to kind of understand them if we put them into categories. So if you look down the left-hand side of this slide, you'll see that we have 4 different types of expenses described here. We have fixed expenses. Fixed expenses are those things that you have to pay. There are a certain amount every period, every month usually, and they don't change very dramatically or very often, but we have to pay them. So they're called fixed expenses because they are fixed in the budget and there's no getting around them. The second category is have to eat, but we have more flexibility in how much we spend at any given time. We might want to splurge once in a while and have a steak. We might be quite content to live on less expensive items the rest of the time. And so we have some flexibility on when and how we spend our food money. And but we do have to spend some, and there will be some minimum level that you want to be at. Transportation is another one where we have some flexibility on how much we spend in a given month. Heat and electricity, we can save money by reducing our usage and changing our patterns a little bit. That's not a huge amount, but it does vary month to month depending on the season as well. Our next category talks about discretionary expenses. We can spend this money or not. Things like clothing. You know, do we buy new winter boots or do we make do with the ones that we've got? And then, of course, we have a lot of discretion on how much we spend for those winter boots. Do we need designer boots or do we need work boots? So the discretionary expenses are much more flexible, and we may delay those expenses until next year or not. So we've got a lot more discretion, hence discretionary expenses. And then, of course, we've got the periodic expenses. These are the ones that happen once a year, sometimes twice a year, 4 times a year, but they happen periodically. And they're the ones we tend to forget because they happen periodically. So vacation is listed here. Are we going to do a vacation? Are we saving money to do that boat cruise or whatever? That would be a periodic expense. But there are other periodic expenses like taxes on our house, property taxes. That comes once a year for many of us. So that type of expense is, again, a periodic expense that we need to think about and keep on our budget so that we know that we have that coming up. I have one coming up this month, BCAA. I have to renew my BCAA, okay? Periodic expense once a year. And there are a number of them that kind of come out of the woodwork once in a while. Car insurance is another one. So keep in mind that those are the ones that tend to blindside you because you forgot them. Okay, so what we need to do is think about these expenses, make a list of our expenses, and then track them for a while, either by going back and looking at what we did, for the last year and then having an idea of what they looked like, or by tracking them for the next 2 or 3 months to see what they look like. And then we can build a budget that says, this is what our spending is likely to look like. Now, as soon as I say the word budget, I'm envisioning some of you just shuddering and saying, oh my God, a straitjacket. But that's not what a budget is. Okay, any plan is a way of looking into the future and saying, this is what we want to accomplish. Doesn't say you have to do it exactly that way. Doesn't say you don't have any flexibility. It doesn't say you're caught in a web or, like you say, a straitjacket. It just gives you the ability to visualize what you want to do. And a budget is just one more tool for doing that. So don't think of it as a negative. Think of it as a positive. Think of it as something that leaves you in more control, something that makes you, gives you the ability to manage better and work on it from that point of view. Never will it be 100% accurate, but if you look at it and you can see where you've gone offside from the budget, and then you say, is that okay? Oh yeah, sure, it's okay. I had a big celebration. My food budget was way up because I bought a big birthday cake and a whole bunch of steaks from my friends. That's okay. Okay, next month, we'll figure out whether we can get back on stream or not. If it's because it's a continuing increase in food prices, then we might have to adjust the budget. But we have a way to know whether or not we're on track. And that gives us comfort in understanding what we can do about it. And on the very right-hand side of this page, you can see there are some strategies for how you can manage some of these things. And they're just very basic strategies. And like I said, you'll get these slides, so you'll be able to look at this more closely. But, you know, if your food budget is running over every month, then one of the strategies, watch for sales. Shop in bigger quantities so that you can get better pricing. Even if that means sharing with a neighbor, you know, go to Costco and get a big lot of toilet paper. But, you know, if you share it between 3 people, then all 3 of you save money on it. And so there are ways to do that. Likewise with transportation, the cost of fuel is just eye-popping or worse. And, you know, what can we do about that? Well, maybe we can do some carpooling. Maybe we can use transit more. You know, we have options. Some of us who are dedicated to our bicycles are using our bicycles more. And, you know, again, a way to beat the gas prices. So there are some strategies that we can use. And if we understand what the problem is, then we can figure out a solution. If we don't have any idea what the problem is, we just know we have no money, then it's really difficult to come up with a solution. So use the budget as a tool to help you to understand what the problem is so that you can come up with solutions. And very often we actually have more money than we think we have, because when we start looking at it, we can see where it's bleeding out of our system without us really sort of thinking about it or realizing that we're wasting money on something that really doesn't give us any satisfaction. That's often a case that we see. The other thing that I find very, very often with budgeting is people don't understand where their money's going. They really have no idea where their money's going. And once they do see where it's going, it just gives them a feeling of power to say, hey, I know what I'm doing now. And, you know, even if you're not short of money, even if the end of the month doesn't come long before the end of the money, you know, people are finding that by understanding what's happening, they're just much happier. So this is a great tool and a lot of fun once you get into it, if you're crazy like me. Okay, so enough about budgeting, but this is a tool, and there are tools for helping you that will help you to budget. There are electronic budgets, several of them available online. You'll have the resources to be able to look for those, and the one that Anna will send to you as well. So good luck with that. To me, it's fun to know what's happened and how well I did. So I do recommend budgeting as an exercise that you undertake, but just don't take yourself too seriously. Don't make it into a straitjacket. Don't make it into an argument. Don't even discuss it if it isn't discussable. But do spend the time to understand what your life is, your money is doing with your life. Okay, one of the big things about retirement, okay, we're not getting any younger. And we all have a lifespan to plan for. So how long is that lifespan? How long do you plan for? And this is a stark question, It may be one you don't want to look at, maybe one you don't want to answer, but the reality is that you're no longer looking at 50 years into the future, likely. You're likely looking at a much shorter lifespan, but that span is a lot longer than your parents or your grandparents looked at. And so what does it look like? Well, today in Canada, we are looking at males with an average lifespan of 80 years and females with an average lifespan of 84 years. Now, BC is the same, except females have an expected lifespan of 85 years. So women are expected to live longer than men, and that because of our good living, I think, I'm not sure. But it is an average of the population and the actuarial studies, and shows that most of us can expect to live to 80 if we're male and 85 if we're female in BC. Other provinces have slightly different lifespan expectancies, but that doesn't mean that if you move to Manitoba, you're going to live less long. This is just an average. Does give us a planning horizon. Now, you can get it more centered to you by doing some calculations of your grandparents and parents and how long they lived, and that might pinpoint for you a bit more what you can expect. But realize that it's only as good as it's not, because it's not just genetic, it's only as good as the paper it's written on, sort of. I have, if I go by what my parents and grandparents did, I died 3.5 years ago. Okay, obviously I'm doing quite well in my death, but 3.5 years of past the life expectancy based on what my parents and my grandparents had. So I think we all need to look at not only our genetics, but also our lifestyle choices that we've made. And of course, our how healthy are we right now, because that will dictate kind of how long we can expect to continue to live. So our planning horizon, regardless of any of this, is shorter than 50 years. Obviously, it's going to be somewhere in the 20-year horizon, probably for most of us, or a little bit less. But to understand what that horizon looks like and to start to work on what that means to us is an important part of this. Okay, so if we know we've got a certain horizon, we know we've got a certain amount of money coming in, we know we've got a certain amount of money that has to go out, then now we've got the tools to understand what should we be thinking about? What should we be doing in order to make this all work? So, stretching your entire accessing our funds, making sure that we can access the money that we need to access, and how we're going to do that. Minimizing our taxes, because of the less money we have to send into the government, the more we get to keep for ourselves. And then protecting our assets from inflation, which is not as easy as you might think, and from fraud, which is really important these days. So we're going to look at those three things from the aspect of making sure that your retirement resources are there for you. Okay, so let's take a look first of all at accessing our money. So we know that we have some money in savings. We know we have some money coming in from government sources and pensions. But where else might we generate money? Where else might we generate cash? So we have things like GICs, bonds, stocks, things that are in investment vehicles. And we can plan on how we want to sell portions of these investments to generate cash if we see from our budgeting exercise that we need more cash every single month or every single year. If we see we need money, more money, but for periodic or special events and special periodic items we want to do, like a vacation. So we look at, first of all, those investments and what does it take to cash them in, and how much of them do we want to cash in, and what kind of lifespan do we want to put on those investments so that they're available when we need them. And so that's going to be part of our strategy as well. Now, some of you have a home or real estate, and these are things that you can look at how you can use those items to generate money. So if you have a house that you're living in and you want to continue to live there, what can you do? You don't want to sell it. And one of the things that you see quite a bit on TV right now is get a reverse mortgage, CHIP reverse mortgage. These are wonderful things. And what a reverse mortgage is that you take a loan out on the equity you have in your house. That loan, you get the money right now, you don't have to pay it back, but it continues to draw interest. Okay, so the loan that you took out, interest accrues on that money, and that just gets added to the principal. So by the time you no longer need that asset, when you die, when you no longer want to live there, you've died, whoever gave you the loan probably owns the whole thing, because they do pretty good actuarial calculations that say, okay, your life expectancy is such and such, so we expect that the interest will be up to this amount, and so we will own the home by that point in time. So very often with a reverse mortgage, it's great if you don't have anybody that you want to leave your real estate to. It's a great way to ensure that you have money to fund your retirement, especially in, if it's a little bit longer time period. But the problem is that if your asset is an appreciating asset, you very often will not get the benefit of that appreciation. You're giving away that appreciation to the lender. And so reverse mortgages do right now have not a very good reputation because of that. So make sure that you understand the implications if you're looking at doing the reverse mortgage. It is a way for you to have a good retirement. But if you have family who have worked hard to build a set of assets, then there might be other implications to think about. Other ways to get money out of things like real estate, you can rent a part of your property. You can become a landlord. And I know of several seniors who are renting out rooms in their house. It gives them money coming in every month, makes better use of their real estate, and gives them company on top of that. So I know of a couple of, or several actually, women particularly, who are renting out part of their house, and that works for them. I know of a couple who have a nice big house. They're renting it out and turned around and are renting a smaller place for themselves. That's another way to make use of your real estate. And so your house generates enough money for you to rent another place plus pay some of the bills. If you have more than one property, obviously rental is a way to go, or selling them, because right now the market is pretty high. That might be the way to go as well. So a lot of things to think about, especially with something like real estate. Okay, I want to just talk a little bit about annuities, because this is a flat rate income stream that you can get when you get a pot of money. You put it into an annuity, depending on the interest rate, you can, and the number of years that you want to get the money back out, you can set a certain standard or a certain amount that you can continue to get out. Annuities used to work very, very well in high interest times. They were great, but interest rates are pretty low right now. And so annuities have a tougher time paying. And one problem with them, obviously, is they do not keep up with inflation. So there are some issues around annuities right at the moment, but they do make planning better as you get to certain stages of your planning horizon. Okay, so go to an expert. This is my advice always. Go to an expert who understands money and get some specific advice rather than just going with general. Okay, minimize your taxes. And I think this is a game that all of us played our whole life. But again, how we withdraw our investments, I talked about that a little before. How we can split our income between us and our spouse. That again has implications. If one of you has high CPP and you split it with your spouse, and then your spouse dies, you've got you lose some of your CPP. So, you know, there are downsides to some of these things as well. Again, you want to go to an expert. But timing your withdrawals is something that you can do very easily. Again, with advice from your tax advisor, your financial advisor. And some of these decisions need to be made in November or October, not in January or February, because that's too late. So, you know, this is a year-round thinking process. And then make sure that you apply for any tax credits and benefits that you are entitled to. Every senior has at least $20,000 worth of protected income. You have tax credits that are available to you that will cover the first $20,000 that you get in a year income. And then some of you will have more than that, depending on your circumstances. You might have disability, you might have medical credits, you might have a number of other credits that are available to you to bring that tax-free portion up. And so get some good advice so that you know where you're at, and make sure you use at least your tax-free zone every single year. And then, of course, if you have an estate, do some estate plannings to make sure that, number one, you benefit from your estate. So while you're alive and while you're needing the money, that you get the money, and then when you no longer need it, that there's something left for those that you want to give it to, rather than leaving it to the government. So estate planning is part of this whole picture. Okay, I'm just going to talk a little bit. I'm not going to talk much about this one because there is a whole course on fraud prevention, and this may be something Anna wants to take a look at because it's a really good course. But there are a lot of people out there who would like to have your money, take it away from you so they can have it. And that would take away a lot of the worries about your money, but it would not take away the worries about living. So be careful. Be careful when you're out there. If it sounds too good to be true, it is too good to be true. If it's not something that you wanted to buy, don't buy it. If it's not something you're sure of, don't do it. Ask someone else before you say yes to anything. And this is whether somebody knocks on your door, whether somebody approaches you at an event, whether somebody calls you on the telephone. There are so many scams out there. Just be careful and, you know, protect your money. Now, you don't have to mistrust everybody, but you do have to think it through. And it doesn't, you know, your grandchild, if your grandchild got into trouble somewhere, your grandchild will figure out a way to get out of it. And more than likely what's happening is not that your grandchild is trying to get money from you. It's somebody else who's using your grandchild to try to get money out of you. These scams have been around for years, and they just get better and better at scamming people out of their money. And too many seniors get caught up in it. Don't. Just say no. Just say no. Okay. I want to talk, and this is really the last area that I want to talk about, and that is that there are strategies that you need to think about. So retirement. When you first retire, you're into that mode of, this is great. I need to do all these things that are on my bucket list. I now have the time. And so you're going to be spending more money at this stage in your retirement than in the later stages. But that will be discretionary spending. That will be money that you spend on things that you want to do. That's good. That will last for a little while, usually 3, 5, 7 years. And then you're going to move to the stage of, now you have less energy. Now you have fewer things that you still want to do. So the maintenance stage. And this will be a lower spending stage and may last longer, but will be a lower spending stage where you're happy to sit down, watch your programs on television, maybe go to the gym or do your exercises online with an online prompt, but those sorts of things in a given stage. And then you move into the most expensive stage of retirement, which is your dependence stage. This is usually a very short time, can be quite expensive, but it'll be a very short time. So as you're looking at your money, it's important to realize that not all years are equal. They're not all the same. And you want to live each stage of your retirement to enjoy it to the best of your ability, and realize that different strategies will help you to do that. So how much risk will you be willing to take for each of those stages? And you need to look at your investing strategy, your investments, to realize that take more risk with the longer term funds and less risk with the shorter term funds. So the spending right now, you know what that's going to look like. So you're going to take low risk for the next 5 to 7 years worth of living expenses. Then you're looking at your maintenance years, and those are lower requirements. You might take a little bit more risk with the funds that you set aside for that, just because you don't, you know that that's a pretty flat stage. And then a little bit of money set aside for those final 2 or 3 years, which are going to be expensive, but shorter. And that money can go into a higher risk, higher return portfolio to pay for that. And whatever you don't use, that will go into your estate. So some common strategies, and again, a good financial advisor will help you to make the best of this. Okay, last cautionary tale. Adult children run into problems. They need money. Should you do it? No. You need to finance your own retirement first. You don't need to finance your adult children first. They come second. And so if you have extra money, if you're ready to give it to them, that's fine. But only if you don't need it. Because very often the problems that they get into, and these often center around things like divorces, they need to solve those problems themselves. And by you putting money into it, you're not really helping them. So again, just say no when you can, and really think through whether or not what you're doing will actually help them. Okay. And then, of course, in your estate, you can definitely help them by having a good will, a will that will give good instructions upon your death, having powers of attorney in place that say, this is what I want to happen while I am still alive, but maybe not as clear thinking as I am right now, and directives as to how you want your health looked after. Do not resuscitates are a huge part of this whole instruction. So some things to think about that are maybe a bit beyond the earlier thinking, but in the long term will make a difference. All right, so that covers what I wanted to talk about. You will get copies of these. There are so many resources out there that are really good. And like I said, CPA has a number of them. Service Canada, retirement calculators, financial consumer information from the consumer agencies to help you do your budgets and so on. So, please feel free to look at some of these if they are of interest to you, and will help you with your planning.